How to manage cash flow problems. Managing cash flow doesn't need to take longer than about 30 minutes a week. Here's the system. Listen, pilots don't fly blind, neither should you as a business owner. I'm about to show you the cockpit you can fly from. By the end of this video, you're going to know the 6-step manage methodology for controlling your cash flow. We have the opportunity to be able to talk to business owners just like you, literally all over the country and all over the world. And there's a common refrain that comes out when we have these conversations with business owners, and it's sort of this cyclical script that I can't figure out. And there's two major problems that people deal with. One is people, because we're just human beings, we're broken, there's a lot of things we got to deal with. But the second is always money, dealing with money. And if we boiled it and distilled it down, it would really be about this issue of cash flow. And so is there a way for us to build a predictable system around that? And the answer is yes. I'm going to walk you through how to manage that. So when we're managing this cash flow, the first thing we need to do is we need to meet with our dashboard. Well, that's not a person, Scott. I know, but we need to create one. And I'm even going to put something here called the ABCs. So that's how we're going to line out the dashboard. What do I mean by that? Well, when we meet with our dashboard, that means we've got a dashboard, number one. And number two, we're going to repetitively, predictably, and meaningfully sit down with that dashboard and update it and review it to see what it tells us. We want that dashboard not to just be there because it's interesting, but we want it to be there to inform us for something different that we need to be doing. So the ABCs of that dashboard are simple. It's your cash accounts, your bookkeeping, accounts receivable, accounts payable, and your customer metrics. So when we look at this dashboard, we want to track every single week, what does our cash accounts say? You've got to be aware of your cash accounts. Your profit and loss statement and your balance sheet are insufficient for this. Look at your cash accounts and know those every single week. Then we need to know how much we're owed receivables and how much we owe payables every single week. And then we need to know our customer metrics. What new opportunities do we have on the horizons? What activities are we giving to lead development and lead generation? What sort of sales cycles are we going through? What's our kill rate? All of those sorts of things need to be tracked on a weekly basis. This gets you a metric health, so we need to meet with our dashboard every single week if we want to punch cash flow problems in the face. And as a part of that dashboard, you have these, and so what we want to do is we want to automate our subdivided cash accounts. Now, most business owners run from 1, 2, or 3 big bank accounts. We want to stop doing that because when we've got all of our money in just one big lump sum bucket or 2 buckets or 3 buckets, I don't know which money goes to cost of goods and which goes to taxes and payroll and all of these other expenses out there. And so what I want to do instead is I want to go to my bank, literally go to your bank and set up about 7, 8, 9, 10 different bank accounts. And when income comes in up the top, it goes into an all income account. And then we sweep it by percentage into these individual accounts. 7% goes to profit, and 8% goes to tax, and 23% goes to operating expense, and 38% goes to cost of goods. Whatever, I'm making those numbers up. But you get my point. Why do we do it by fixed percentage? Because if your account runs out of money, then you know that your P&L is not right, and your cost of goods are actually more, your payroll is more than what you think it is. Or if a bank account builds up a ton of money over time, then you know that you've actually tabbed too much percentage for that particular thing. But you can't do this on a spreadsheet, and you can't do it in 1, 2, or 3 bank accounts. So we've got to automate our subdivided bank accounts so when money comes in, it automatically by percentage goes out to these separate accounts that we have. Once we got the dashboard and the subdivided bank accounts, we can start to navigate a 13-week forecast. Why 13 weeks? Because every year has 52 weeks in it. If we subdivide it by 4 times, quarter, that's 13 weeks, every single quarterly cycle. But what we want to do is do this on a revolving 13 weeks. Because with this dashboard, we're going to look at this every week. We're going to update it every week. So we're always 13 weeks out looking to see what cash is coming up. What is our customer metrics telling us about our pipeline in the future? How much are we owed and how much do we owe? And so we're going to constantly keep on a 13-week revolution. This keeps us ahead. We have helped clients see cash flow crunches 3 and 6 months in advance, which allows us to make different decisions in the moment so they never feel the impact of that cash flow issue because they're way ahead of it because of these tracking dashboards. That leads to the A part of our manage, and that is we're going to assign percentages to these cash accounts up here. So when we look at these right here, every cash account is going to have a defined percentage. And it goes back to telling you why we do that. It's because if you did a fixed number here and you put $5,000 in profit every month, or you put $50,000 in operating expense every month, we don't know if the revenue that's coming in can support what we're putting into that. But if you do it by percentage, now we understand by percentage. When the revenue comes in, it's just a percentage of that, a percentage of this. And if we run out of money, then the business is not affording that. If we have too much money, then we can reallocate percentage with it. So you need to coordinate your bank accounts by percentage. What's cool about the percentage mix, especially when we look at our dashboard on a regular basis in a revolving 13 weeks, is every couple of months you can look at it and decide to up the percentages or lower the percentages. The percentages on bank accounts are like levers. If I raise the percentage on profit by 1%, that means I need to go to some of the other accounts and lower it there. Too many of us try to raise our profit take while never decreasing some of these other things. That's why the percentages are so helpful. And so we've got these things set up, dashboards and subdivided bank accounts and 13 weeks and assigning percentages. But if we don't guard our terms, we've got to guard our terms so fiercely, because it's in the terms that determines when that money comes in, when it comes, when it goes, what the percentage on that look like. When you send an invoice to a customer, or when you're getting payment from a customer, are you clear with the terms? Hey, this is due in 30 days. Have you communicated that clarity? And this is even more important, do you have a reminder structure to remind them, hey, we're 14 days out from final due payment. Hey, we're 7 days out. We're 3 days out. We're 1 day out. Hey, just a reminder, if you are overdue, there will be a penalty on this. You've communicated those terms up front, and you communicate them frequently. One of the biggest issues of cash flow is your 30-day terms turn into 45 days, 60 days, 80 days, 90 days. They're holding on to your cash, and because of that, you don't have options, and it forces you into bad places like having to go after hard money lenders or revolving lines of credit that constantly revolve and never stop. We've got to guard our terms fiercely and communicate those terms on a regular basis. And then the final element of managing these cash flow problems is to come down here and examine our business and examine what we call the rage slim pants. We want to rage over our money, and we want to be lean as a business to fit into slim pants. What do I mean by that? Walk through this with me. First, to rage over your money is for you, the owner, to, quote, know the numbers. If I were to come ask you today, what's your total revenue projected this year? Most owners kind of, I don't really know. And then I say, just give me a ballpark. And they're like, well, I don't really know. You got to be able to give me a ballpark. Then your associated cost of goods sold. What's your percentage of cost of goods? I don't know, it's 30. A lot of times somebody will tell us the number. When we do a little digging, it's far different from that. Do you realize what a 1% move impacts for cost of goods has on everything else downstream? We've got to rage over our numbers. We've got to know these numbers. Our revenue, associated cost of goods, which will then give us our gross margin, revenue minus cost of goods, gross margin, that's what we call our real revenue. And then that tells us what our expense to profit can be at that point, how much we have to run the business in order to maintain a particular profitable number. All right, so that's raging over the money, but then in order to get lean in the business, this is where we fit into our slim pants and run lean and stave off this idea of cash flow issues. So I'm going to walk you through it. You ready? First, we've got to obsess over being slim, looking at our schedule, our labor cost, our inventory, and mistakes, callbacks, and warranties. What metric do you have? You can even put it on this dashboard up here to be able to track weekly these things right here, which leads us into the PANTS version of our acronym. It's looking at pricing on a regular basis, obsessing over our terms and going and grabbing our accounts receivable and accounts payable, reinvesting for new equipment or capital expense, putting money away for our taxes, and then also paying attention to servicing of our debt. Remember, we've got these revolving line of credits. Sometimes our back's against the wall. I want you away from that. You can have a profitable business without debt. In fact, you can set up one of these cash accounts right here to what we call a PLOC, or a personal line of credit. You put money in that cash account, and over time, 12 months, 24 months, 36 months, you can start to front load projects on your own, and you don't have to go there. It can be a rainy day fund for you to be able to do. And so when we can start looking and fitting into our slim pants by raging over this, we can begin to manage the cash flow in the business so you're in the driver's seat. I want to give you a special tool that I think is going to be helpful for you. Go in the description link below, click on solvecashflow.com. Our team and I have built an incredible handbook for you to be able to walk step by step through building out and managing this cash flow for you in a way that's super easy. But here's what we need from you: repetition, predictability, and meaning. Thomas Edison said, vision without implementation is hallucination. I don't want you to hallucinate. I want you to implement so that you can be liberated from cash flow chaos and make time for the things that matter most.